afternoon, everyone. I'm Sarah Rosen-Wortel, and I have the great honor to be the president of the Urban Institute and to welcome you today. First, let's do very quickly some housekeeping. Our event is being recorded and we'll post it online afterwards where you can find it if you want to review later. The biographies and Twitter handles are available on the website. And so I'm not going to belabor stellar resumes today, but I encourage you to take a look and also to join the conversation online. You'll find their Twitter handles there as well. And if you use the hashtag #LiveAtUrban, others will be able to see your reactions who are also watching along. You can hide the captions or adjust your settings with the live transcript button. All of the audience is muted, but you can type your questions or comments into the Q&A box at any time. We'll see how many we can weave into the conversations a little bit later. And finally, you really do us a big favor if you take 1 or 2 minutes at the end to complete the survey. And that survey will help us, not only all the participants, to see what interests you, but also help us know how to do a better job of these events in the future. So with that, if Neil, you would join me, it's my great pleasure to welcome Neil Kashkari, who is the president and CEO of the Federal Reserve Bank of Minneapolis. He's also a member of the Urban Institute Board of Trustees. Neil, thank you so much for being with us.
Thanks for having me. It's great to be with you.
There are many discussions about inflation these days. I think it's probably close to your full-time occupation, but I hope today's is going to be just a little bit different. We're going to have a slightly different focus because, as you know, at Urban, we're especially looking hard at the lives, the challenges, the opportunities that are facing low and moderate income families. And so that's the lens through which we're going to talk about inflation and employment today, which are the twin sides of the Fed's dual mandate. And as you know, our audience sometimes isn't as maybe always as deeply enmeshed in these conversations. So I'm going to occasionally ask you to pause and explain a term or two. But let's start with inflation. As you know, consumer prices rose 8.3% over the year. We've now had 2 rate hikes this year, and clearly there are sizable additional hikes ahead. So what do you think it's going to take to get us back down to the Fed's inflation target?
Well, it's a great question. And there are 4, one of the key concepts that we wrestle with is the Fed providing support to the economy, like boost, or is it restraining the economy? What is neutral in terms of monetary policy? And as I think about it, there are 4 components to that. One is the level of the federal funds rate. And you noted we've raised rates twice by 0.75%. There's also the composition of the Fed's balance sheet. The balance sheet is very large relative to history. We expanded it during the crisis. But then there's also the expected path of the federal funds rate and the expected path of the balance sheet because financial markets are forward-looking. So while we've only, quote unquote, only raised rates by 75 basis points over the last couple of meetings, we've actually done quite a bit to remove support for the economy through our forward guidance about where the federal funds rate is headed and where the balance sheet is headed. And I'll give you an example. If you look at mortgage rates, the 30-year fixed mortgage rate was around 3% in the beginning of the year. It's now around 5.25% already. It's a dramatic increase in mortgage rates, and we've only moved the federal funds rate by 75 basis points. That's because we have done a lot with our forward guidance. And by that measure, we are removing accommodation even faster than we added it at the height of the COVID panic. So the question is, have we done enough? Are we doing enough? And the answer, unfortunately, is I don't know. At a minimum, we have to walk the walk, and we have to follow through on all of the forward guidance that we've provided in terms of the federal funds rate and the balance sheet. And I'm confident we're going to do that. But is that going to be enough to bring inflation back down? There's where I don't know yet, and I don't think we know yet. What causes inflation? It's a mismatch between supply and demand. Supply is being held down because of the virus and the pandemic and supply chains, and then demand is high. We can bring demand down through our policy tools, but if we get some help on the supply side, then all of the burden of balancing supply and demand won't fall on our shoulders. That's the piece of which I don't know yet. I know we're going to get inflation back down, but is the Fed going to have to do all the work? I don't know.
All right, and I want to talk about the falling on your shoulders and then whose shoulders in the economy it falls on as well. But before I do, just one quick follow-up. what are the indicators? I mean, I know you're looking at all indicators. I know that's going to be the answer. But as you look at whether you're doing enough, what are the indicators about where the rest of the economy is coming back, or what work others are doing that you're watching especially closely to help you figure out whether enough is going to be enough once you follow through with what you've already projected?
Well, I pay a lot of attention to the labor market. The labor market has healed a long way from the COVID pandemic. We're not back fully. We're not fully back in terms of labor force participation or employment to population ratio, even though the unemployment rate has fully recovered. So are some of those workers that are still not in the labor force, are they going to come back in? I'm optimistic they will, and how quickly. Also, of course, paying attention to wages. We hear from businesses everywhere that they can't find workers. They're having to bid up workers. Higher wages is good for attracting workers back in, but we're also concerned that if wage growth sticks, it could lead to a wage price spiral and make bringing inflation back down more difficult. So labor market is a big one, and then focusing on those supply chains that I talked about, and of course, focusing on all the different measures of inflation and inflation expectations. We're very focused on making sure that high inflation does not get embedded in people's expectations, because then again, our work will be harder to reset those expectations back to a 2% inflation target.
So I've used the expression recently, it's not your father's or grandfather's Federal Reserve. It looks different, it talks different, or you and your colleagues have been engaging in different conversations. In 2020, it issued a major revision of the policy framework. And I'm not sure everyone in the audience sort of understands what that document is and how it works. So could you describe it super quick and what changed, and then talk a little bit about how the framework is affecting your implementation of monetary policy in this context?
Yeah, so our framework, think of it as our constitution for how the whole Federal Open Market Committee agrees we're going to conduct monetary policy. And we said we're going to review this every 5 years. And prior to the pandemic, we had a conundrum. All advanced economy central banks did, which is inflation was too low. It kept coming in below our 2% target. And by my judgment, we kept misreading the labor market. Every time we thought we were at maximum employment, there are no more workers out there, more workers came back to work. And it turned out the US economy had greater supply potential than we realized. So it's a complicated thing, but we basically said, if this is the world we're in, let's adjust how we conduct monetary policy to give us more power to deal with a low inflation environment. But it wouldn't necessarily change how we operated in a high inflation environment. It was just more powerful in the low inflation environment. So I supported it. It was a very thoughtful approach to that world. Now, of course, we're in a different world. We're in very high inflation, and by almost any measure, we're in a very strong labor market. So as I look at it, the framework is actually not binding right now. It is not adjusting how we're conducting monetary policy today. It is designed, if we go back to that low inflation world, to give us more tools there. And so I think it's an open question. Are we eventually headed back to that low inflation world? Are the demographics and those factors that drove us there, are they going to reassert themselves? My base case would be yes, but we need to reserve judgment and see what happens. But it's not a factor right now in how we conduct monetary policy, as I look at it.
One thing that document did have, though, was it talked about full employment being a broad-based and inclusive goal, which I read, maybe misread, but I read as saying it's not just about the overall inflation rate, but as you know, the law of averages can disguise a whole lot of very different experiences for different parts of the population. And I'm seeing in your discussion and that of Governor Brainerd and others, growing interest in the impact of both inflation and unemployment on different parts of the population. Am I right? Is that part of the conversation now?
It absolutely is. And again, it goes back to what I would consider was, and this is not I don't mean to be harsh, but it's an honest criticism that we didn't, if you just look at the headline unemployment rate prior to the pandemic, it masked the fact that there were still pockets of labor available, people who were stuck in part-time jobs, who wanted to work full-time, or people who were not employed at all, who wanted to be, if given the chance, and if some barriers were reduced. So we realized we need to look at a much broader set of measures to determine, are we in fact at maximum employment? Now, prior to the pandemic, we had low inflation, so we were undershooting on both sides of our mandate. That forced me to say we need a new approach, and I think my colleagues agreed. Now, of course, we have very high inflation, much, much too high. And by almost any measure, we have a very strong labor market. And so this is, I've said this publicly, it's easy to be a quote unquote dove when you're undershooting on both sides of your mandate. It's easy to be a hawk if the labor market is very strong and you are wildly missing on the inflation side of your mandate. And that's the regime that I feel like we're in right now.
So as you're talking about the impact of inflation and interest rates on the economy and how you're trying to move that through monetary policy, how are you thinking and talking about low-income households in particular? So they are the ones in many ways least resilient to economic shifts, and your own research and research by Urban and others have been documenting the ways this moment is particularly landing on those with low wages. So how does that factor into the conversations? What are some of the things that you're looking at and watching?
No, it absolutely factors in. I mean, it's a reality. Inflation affects everybody in the economy, everybody in the country, but the burden of it falls greatest on those who can least afford to bear it. Not only do lower income households have less resilience to be able to pay higher prices, they're also buying, they spend more of their income on housing, on food, and on energy. Those have gone up quite a bit. And so even the basket of what they buy is different than the basket of higher income folks. And so it's a really unfair thing that we are all experiencing, but that they are experiencing especially. Now, the flip side of that coin is a lot of people have said, well, Fed, if you raise rates like you've done historically and the economy goes into recession, who's hurt by that? It ends up being the lowest income workers that are most likely to lose their jobs, that are most directly affected if the economy goes into recession. So it's really unfair, both in terms of inflation and in terms of potential cost to the labor market. So we think about this all the time. My colleagues actually go out with me and we meet with low-income workers. We meet with low-income groups. We meet with labor groups to understand what they're experiencing. One of the things I heard about this morning was workers who have to drive to work or who get reimbursed for their driving on the job are saying, hey, my reimbursement rate is not keeping up with gas prices, right? So there are a bunch of things that are designed to support workers that are not necessarily indexed to inflation or not indexed in real time to inflation, and yet they're bearing those costs right away. So we know we have to get inflation down. We're going to do everything we can to achieve a quote unquote soft landing. But I'll be honest with you, I don't know the odds of us pulling that off. Some of it is out of our control, and it's related to what happens on the supply side of the economy.
I love hearing you tell a story about going out and gathering a data point from those experiences. We like to say that lived experience is evidence too, along with the quantitative factors, and perhaps something that the Fed has not always been as good at getting a broad-based set of inputs to. So very important. I've been noticing that from a number of your counterparts as well, and hope that continues. So I wanted to talk briefly about the housing market, something near and dear to us. We are seeing enormous house price growth, driven, you tell me, but clearly shortages of supply has been a profound effect since the Great Recession, and very high levels of demand. And these are not transitory issues, just born from the current moment. So how do you and your colleagues assess how housing contributes to the inflation we're seeing? And as you know, monetary policy works through the housing market, through interest rates. It's one of its big levers, if you will. So what are you expecting is going to be the impact of these higher rates on the inflation and the economy in the whole?
Well, you're right. It's both a demand problem and a supply problem in the housing market. And again, through higher rates, we can tamp down a little bit on the demand side. It's not going to help on the supply side. And some say, hey, it's going to make the supply side worse because on the margin, it's going to raise the cost of investment into the economy. But as you also said, Sarah, the supply side challenge in the housing market is a long run challenge. We have to address inflation in the near term, get inflation back down. The best way that I can think of to address long run housing is to get inflation back down so that investors have comfort of knowing they can make reasonable investments in housing, bring more supply online to bring demand and supply into balance. So there's a long-term issue and a short-run issue. We have to address the short-run issue. It's important that we do that, but long-run issues are real. I'll tell you, in my district, everywhere I go, even before the pandemic, people complain about affordable housing. And I say to them very bluntly, the reason it's so expensive to build homes in my district and around the country is people like me who own their own house create barriers to prevent other people from building homes. That's what it comes down to. You and I who own our own homes, whether we want to admit it or not, are part of the problem, a big part of the problem, and we erect these barriers. Maybe we put good reasons under it, but that's what we're doing. We're erecting barriers that holds back supply because we want
preserving neighborhood character, which is in many ways something we work and write and talk about zoning and lots of other things. I think you're exactly right.
Exactly.
And I also really worry because as important as getting the handle on inflation is for all the reasons you articulate, how also are you thinking about the impact of rising interest rates on access to home ownership and its wealth building effects? I mean, particularly now you live in a city where the black-white wealth gap is just enormous and home ownership gap is huge. Those moments when you see rising wages or when people might otherwise be able to enter into the housing market, and yet with the rising rates, we're worried very much that they'll be the last to be able to enter the
I agree, but look at the alternative. If we did not deal with inflation, we allowed the home prices to continue to accelerate the way they've been accelerating, they're also unaffordable for those workers who are trying to get in and break into the housing market. So the best thing we can do is get inflation back down, have a healthier, sustainable housing market with a lot more supply coming online.
So a couple thoughts coming from our audience here. The first is really about the role of other policy actors beside the Fed. And I know that's not directly your mandate to give them advice, but if you want to talk a little bit about what can other parts of policy, childcare policy, education support, other things do to try to housing policy to decrease the pace of inflation, or does all of the solutions have to rest on the Fed's back?
Well, no, I mean, the near-term solution is really on the Fed. The other big, huge elephant that we have not talked about is immigration. A part of the missing workforce are missing immigrants who have been coming into the country to contribute to our economy and fulfill very important jobs across the income spectrum. That has really dried up because of the pandemic. And so, advanced economies are all having fewer children than prior generations. There's no quick way to change that. And so unless we really utilize immigration as a tool to support our economic growth, this is going to be a real challenge. That can only be dealt with at the federal government level.
So another one of our questions is really about our assumptions. And you started talking about how the framework that the Fed was operating under worked under one set of circumstances, but we're seeing a set of circumstances we haven't seen since the 70s. Are there other things that you are maybe rethinking about orthodoxy in economic policy making, about the relationship between different forces that are coming up as a result of this very unusual pandemic experience?
I mean, I think it's forcing us to rethink everything. I mean, I'll give you a quick example. I talked about, are we in this old world of secular stagnation or are we in some new world? I'm seeing some evidence that we might be in a longer term high inflation regime. Household balances, even balance sheets, even for low income workers, are much better on average than they were before the pandemic. Are these stronger balance sheets leading people to spend more, to be more confident, to just change their behavior, their spending patterns? And is that more sustainable? In which case, maybe the Fed has to be even more aggressive to reset the economy back into that regime consistent with 2%. I think that coming out of this pandemic is forcing us to reconsider a lot of things that we thought we knew for certain and just re-examine those and test those assumptions.
How we work, our relationships with our employers, where we work, there's a lot of dynamics like that. One question that one of our colleagues asked here is, actually about the role of the consumer in all of this. Obviously, each of us individually, but do you have thoughts, advice for consumers, either how they can manage their own impact of this environment or what role they play and their assumptions play in the rising pressure for inflation?
I think most people are very creative at trying to take their own money and get it to go a little further. And if it's whether I shop at Costco, whether it's seeing more people going to these large goods stores to try to save money by buying in bulk. But again, that's a luxury. The lowest income workers actually don't have that luxury of buying in bulk because they don't have the resources to do it. And so, I'm very sensitive to the fact that even things that I think might be easy steps to take to stretch your dollar, it's not available to everybody. And so it's a huge challenge that, again, disproportionately falls on the lowest income families, unfortunately.
So I suspect I know how you're going to respond to this, but you're on MSNBC and others see CNBC a lot, so you get asked a lot about the stock market. So our audience is asking about the market as well. Is in some ways they're suggesting the kind of volatility and drop that we're seeing in the market actually helpful to this effort to try to soften demand? I know it's not the indicator you're looking at to make your decisions, but how does it play into these demand motivating factors?
Well, I think the research is pretty clear that the wealth effect is a real thing, that when people have those who have stocks have higher 401ks, they feel more confident, they go out and spend more. When those things start to come down, it may change their behavior. So no, we do not target the stock market itself, but we are aware that there is a feedback loop, and we do pay attention to that feedback loop in terms of what it means for our dual mandate. So I think the fact that the markets are adjusting, both the bond market and the stock market is adjusting to our guidance, I think that means that the Fed has a lot of credibility, and we should, and they should take us seriously because we mean it.
So maybe a chance for you to make the case more explicitly than I think you were making this earlier. But someone has asked, it's clear that low interest rates are helpful to investors, but sort of what is your case for why low interest rates are important for workers? And I think there's a hint in some of the questions and comments I'm getting of skepticism about whether, in fact, higher interest rates and even inflation is actually just a real boost to wages and therefore good for the bottom of the market.
Well, you're right. I mean, the bottom of the lowest income workers have seen the fastest wage growth across the economy. By some measures, it's kept up with inflation, but the risk is that it just makes our economy grow slower going forward. It means that there's going to be less investment going forward. It means there are going to be fewer job opportunities and worse job opportunities going forward, as an example. And so getting inflation back down is actually of paramount importance to having a robust economy. Now, it's one of my lessons from the 5 years before the pandemic. Americans want to work. If given the chance to get a decent job, the vast majority of people want to work, and making sure we really understand what barriers are there, giving people a chance to work. Low interest rates can support that. I believe in that. And I was probably the most dovish member of the Federal Open Market Committee for that reason. But that was when we had low inflation. Now that we have high inflation, we've got to bring inflation back down so we can get to that very strong job market that everybody can participate in and have strong growth and a bright future for the economy overall.
So let's closing out question at the Urban Institute, no surprise about housing once again. So there is a set of questions here that I won't read them all, but that are really getting to the way that the dynamics around the interest rate increases are going to affect the housing market. Some people are asking whether or not there was a big, almost a historic number of homes under construction in response to the sort of huge price increases we were seeing. We would argue there's been a huge, many-year-long development of a gap, so we needed to see that surge. But there is a concern that potentially that it might, with the quick jump in interest rates, it's going to put a brake on that. And if in fact house price inflation is due to lack of supply, one of the things that might be mitigating the problem will actually be will be stopped in its tracks. How do you talk about that?
The housing market is very strong by almost any dimension. And if you look at the financial position of borrowers, mortgage borrowers, it's much stronger than it was, say, in 2005 and 2006. So my scenario that I would like to see is the housing market cool off, not keep seeing these double-digit increases in home prices every year. But that's a far cry from actually having home prices drop and leading to any kind of 08 correction. I don't see any evidence at this point that we're headed for any kind of 08 type housing correction. But I think the housing market cooling off to let supply catch up, I actually think that would be very helpful. And I don't think that would be destructive in terms of bringing more supply on. The famous quip that the best cure for high prices is high prices. I think that's certainly true in the housing market, but they're going to need some regulatory help to remove some of the barriers that are preventing that new supply from coming on.
Well, lots to talk about, then we'll have you back to talk about housing supply. Neil Kashkari, thank you so much for being here, and thank you for being part of the Urban Institute family. Yes, I see a little applause in the Zoom chats. I didn't know we could do that. This is obviously a new feature. Thanks, Neil. And now I'm really excited to welcome other parts of our friends and family. Please join me, Bill Rogers, who's Vice President and Director of the new Institute for Economic Equity at the Federal Reserve Bank, another one of the banks, this one in St. Louis. We've got Betsy Stevenson, who's a professor of public policy and economics at the University of Michigan, and Mark Sandy, Chief Economist at Moody Analytics. And I thank you all for being with us. So probably lots to unpack in what Neil had to say and your own interests and expertise. I would, let me start if I could, I'm going to hide non-video participants. There you guys are. I guess I'll start with you, Betsy, if I could. So the Fed has been pretty clear, and I think we didn't hear anything different from Neil about his intent to be aggressive this tightening cycle if we need to. What is, from your looking at history and your own analysis, tell us about how likely they are to stick the landing? I think Neil sort of said wasn't sure if they were going to get to a soft one or not, but our ability to control inflation and sustain unemployment and economic growth at the same time. Sort of, what's your sense of the dynamics going on here?
You know, I have a lot of confidence in what they're doing. Every time I hear somebody try to compare this to the 1970s, I think it's just, it's not an accurate comparison. So the Fed has a lot going for it. Neil Kashkari has to come out really strong and to say they're going to get inflation back down to 2%, because what would be a disaster would be if inflation expectations started to shift. And right now, most people, particularly in financial markets, expect the Fed to successfully get inflation back down to 2%. And I think that is very important to them, that they don't lose a handle, lose sort of control of those future expectations. But if you look at why have they been able to hang on to inflation expectations of 2% in the face of 8.3% consumer inflation, it's because they have decades now under their belt of keeping inflation low. And I think that history is really helping them. And then I think there are some structural changes in the economy that means that inflation doesn't quite catch like wildfire the way it could have in the 1970s. And some of that is, due to the structure of the labor market. For example, if you go back to the 1970s, we had a very large share of the workforce that were covered by collective bargaining agreements. Collective bargaining agreements are great, but they do make it easier for a wage inflation spiral to take hold, because workers see that they're having to pay more for the stuff they're buying. So they work with their union to make sure everybody gets a raise that keeps their income up with the price of goods. And then their employers respond by raising the price of goods to their customers, which then leads to the next year needing to give another big increase. And we have about a third, or even maybe only a quarter of the workers covered under collective bargaining agreements today that we had in the 1970s. So I think those things make it very fundamentally different. One of the questions I was asked, and this is that I just loved, was like, hey, maybe inflation's not so bad. We see our wages going up. And, and Neil Kashkari was like, no, that's a bad idea. And I think what's really nice is they need to we want Goldilocks inflation. It's actually true that zero inflation is bad. It's also true that 8.3, not so good. And so what we need to do is bring it down, to a place where we think that it's stable, and that people can expect that prices will continue to rise at that 2% a year, year after year after year. So we do need some inflation in the economy, but right now, we're not in that Goldilocks place. We're in a place where there's clearly too much.
So I'm going to bring Goldilocks back, and I'm probably also going to ask you, Betsy's got a great metaphor about Tylenol that I hope will come back into our conversation as well.
Yeah.
But first, Bill, let me turn to you. In the first quarter, we actually got maybe an aberration, maybe not, some information that GDP actually shrank. And it sort of raised the fears of a lot of folks that we might have the worst of all worlds, which is high inflation and actually the beginnings of some kind of decline or recession. Although when you sort of looked into the numbers, what was driving it was perhaps different. So, from the data and the numbers that you're seeing there in St. Louis, can you tell us how we should think about and understand the GDP decline? And then I'm also going to ask you, if you would, to think a little bit about this when we get to slowing growth, how it's going to land on low-income families and communities of color, which I know has been the focus of your work.
Yeah. Excuse me. Thanks again for having me. And before I begin to answer some of your questions, I do want to give my disclaimer that what I'm sharing are my own views and opinions, and they're not they don't represent FOMC committee policy, nor sort of a stance by the bank. That Jim Bullard, my bank president, he is a spokesperson on these policy conversations, part of the policy conversation here. And just two quick add-ons to what Betsy was sharing that I just want to add is that from my perspective, looking at the timing of the price increases and then the wage increases, there are folks out there who are wanting to make the argument that this is now being driven by wage increases, the inflation we're seeing. And my sense of looking at the timing of when we were seeing the price increases and the way they were occurring, that was leading the growth in inflation, and that it's just recently with the sort of growing number of strikes that we saw back in the end of last year and also into this year. Where we began to see employees asking for cost of living increases so they could stay up. And then the other big picture part of this is, I think some reason why certain groups have been very pushing around is this is great. We need to have wage increases. We have to remind ourselves what we looked like before the pandemic hit. We had rising inequality. We had stagnating wages for not just the lowest part of the income scale, but up through into the middle parts of the income and earnings distributions. And that leads to my second point is that, yes, it's those who are at the lowest part of the income scale are challenged, but it's also these middle income families. So their disposable income has been challenged. And I've done some work with United Way of Northern New Jersey where we created this concept called ALICE, where ALICE stands for Asset Limited Income Constrained and Employed. And it's basically a share of people in your community that don't have the resources to be able to have a survival budget. And prior to the pandemic, that was around 35-36% nationally. And even in my states, in my district, Missouri, Arkansas, we were over 40%. So this is not just something that's hitting folks who are in poverty or just near poverty. Now, apologize. To your question about the GDP number, exactly what you said. You got to kind of peel back the leaves, or so to speak, or pull the petals back. What drove this drop in GDP, and hopefully it will be a one-time drop, but it was a drop in private inventory investment, particularly in the wholesale trade, in the motor vehicle sector, and then also retail trade. We saw these inventories pushing back. Now that could be a warning sign, right, for us that particularly in these areas, employers are starting to pull back. Other areas we saw the decline were exports. Then also you saw a decline in federal, state, and local government expenditures. And this is going to be something important I want to raise later. But this report by itself, there's a potential warning sign in it. But for the most part, at its first quarter, and so that's also, it's older data now, but its first quarter, but still the good news was consumption was pretty strong in it. And that's it. It makes up like 75% of GDP. And once you start to see slowing there, then we need to, I think we should be concerned now as we are, but be really concerned.
So I would characterize that on your behalf as we may not yet be Goldilocks, but we don't know that we're not going to get there. Certainly. So, Mark, I want to invite you just both into this sort of general conversation about where you think we are, and then ask you specifically about one of the tools that we didn't discuss with Neil, but was part of that 4-part tools in the tool belt assessment that he made at the beginning, which is the runoff of the Fed's balance sheet. Given that mortgage rates are likely to be elevated, is the Fed going to be able to shrink its balance sheet at the desired pace, and how will that affect the forces that we've been talking about?
Sure. Well, Sarah, thanks for the opportunity to participate today. You know, I love the Urban Institute, and let me just call out the Housing Finance Center, which I do a lot of work with, and the Tax Policy Center, which does this fabulous work. I know you do a lot of things, but that's where I touch the elephant, and I really do appreciate the good work that you do.
I'm sorry, hold on a second. I think we may need to ask the other speakers to move. Yeah,
I think Bill,
thank you.
there we go. I think Bill was rustling. Bill, you got to stand still, my friend. Stay still. Yeah, there you go. Okay.
Or not, but
Yeah,
we
or
can have some
not, or
fun.
not. You can stay on mute.
Just
Yeah.
be quiet.
Yeah. Well, where are we? Well, the economy's strong. I mean, forget about the GDP number. It's all about jobs. We're creating 500,000 jobs every single month. And that's a boatload of jobs, and it's bringing down unemployment very rapidly. And Neil was debating, whether we're at full employment or not. I don't think there'll be any debate in the next few months. We're going to be at full employment no matter how you measure it here pretty soon. The problem is inflation, and inflation, in my view, is high, uncomfortably, painfully high, largely because of the pandemic and the impact on global supply chains and labor markets. And that's still an issue. I mean, China's locked down, and that's creating havoc in supply chains. And so this isn't over. The pandemic is still a problem. And the Russian invasion of Ukraine, that did a lot more damage to the economy than I thought it would, because the spike in oil prices and other commodity prices, that conflated with the already high inflation, and it caused inflation expectations to jump. And that's when the Federal Reserve went on to DEFCON 1. They went from, yeah, we're going to be raising rates, but it's going to be kind of a measured increase in rates over time, to, no, we got to raise rates very rapidly and get there immediately and make sure everyone knows that we're going to do that to get inflation back and expectations back down. And actually, they've succeeded. I mean, if you look at, 5-year break evens, or 1-year, 5-year forwards, or 5-year, you can see how like the bond market measures more than the other measure of expectations, just because that's people putting their money where their mouth is. And so that means to me something more. But they've come in, and that's very encouraging. And I think the Fed has been successful in articulating, where they're headed, and that they will keep inflation down. And I actually, listening to Neil, I'm probably more optimistic than he is. I bet you if you asked him what's the probability of recession, it sounded like he was thinking it was more than even odds. That's what it felt like to me. I think we're going to make our way through. Obviously we're skating on thin ice, and the pandemic and the Russian invasion can go down lots of different paths that would result in recession. But the economy's fundamentals are strong. I mean, none of the imbalances that normally prevail prior to an economic downturn are in place. Leverage is low. The household balance sheet is strong. Corporate balance sheets are good. There's pent up demand. There's not spent up demand. We haven't been able to sell vehicles because of the supply chain issues, and that'll support spending. And home building, we have a shortage of homes that's going to very different from other recessions when you had a surfeit of housing. Inventories, they've come back in, no sign of being overladen. There's no signs of bubbles in asset markets. It feels like the economy is sitting on a pretty solid foundation, and all we need to get through is a little bit of luck. I think Neil was saying that we need a little bit of luck on the pandemic and the Russian invasion, and we need some deft policy making. So the Fed's got to calibrate. I think they're doing okay here, but obviously a lot of script to be written, and as the script unfolds, they're going to have to adjust, and so they're going to have to be very deft. And that goes to the tools they have, and one is around interest rate policy, and you mentioned the balance sheet, and they're are very articulated a clear path for letting the balance sheet start to wind down. through maturation of the treasury securities that they own and the mortgage-backed securities that they own. They're going to let that mature. So, when that's in full swing, that's about $100 billion a month that's going to come off the balance sheet. Interestingly enough, they may have some trouble through reducing the mortgage securities on their balance sheet because of the pop in interest rates.
Right.
There's not going to be any prepayments. The investors, no one's going to refinance, and so you're not going to see any prepays, and therefore that MBS may stick on the balance sheet to a more significant degree. And that's I think what is elicited comments from Fed officials that, oh, maybe perhaps we're going to have to start selling securities, MBS. And that's why we've seen this big increase in mortgage yields, much more significant increase in mortgage yields than we've seen in risk-free rates, 10-year treasury yields. And I think that just goes to the idea that maybe they'll have to be selling. And there's the other issues around MBS is that when the Fed was buying MBS, they were buying kind of poorer quality MBS with high prepayment speeds. Nobody wants those securities, so it's going to be harder for them to get rid of them, and that just is going to complicate things as well. So there's going to be there's a lot of messiness and kind of in the weeds here in terms of how they're going to do this. But at the end of the day, they're going to allow that balance sheet to wind down. And as you know, all else being equal, that's going to push up long-term rates and help to support the slowing in the economy. So that deft policy making goes to raising rates in a calibrated way and working through all the mechanics of winding down in the balance sheet in as graceful a way as they possibly can. But I think they're up to the task. And, I would put the odds of a recession in the next 12, 18 months still well less than even.
Great. Well, first of all, it's always nice to feel confidence in this conversation. Betsy, I wanted to turn back to you and get the Tylenol metaphor on the table here. I think it's related to what Mark was just talking about, and it's also a good transition for us to go look particularly also at the different effects that different parts of the population experience from this point in the economy.
Yeah, I think when we talk to non-economists, just everyday people on the street who absolutely hate inflation, I don't think they realize at a deep level that cooling inflation, particularly by the Fed, requires cooling demand. So in particular, in the current situation where we're in, Mark just described a lot of the forces. China's not making stuff. The factories are closed because of COVID. That means we're not getting as much stuff. So inflation's being caused by lots of demand. We want all these cars and dishwashers and appliances, and pandemic related problems means that we're having a hard time getting those things. And the result, because we all have a lot of money, because both the Fed and the federal government helped to make sure that everybody was able to sort of weather the storm of the pandemic by having a lot of cash in their hands, people are just pushing up prices, trying to get the smaller amount of cars and dishwashers and stuff that are available. So the solution is let's cool demand, let's buy less. But that's not very satisfying for people. They don't really want less. They want prices to come down and still get more. And I think that is sort of, a fundamental conflict. I wanted to come back to, I thought that Neil Kashkari was more expressed more of concern about a potential recession than I have, or that Mark just said he had. But maybe this is sophisticated Fed communication, because if everybody thinks a recession is coming and they start increasing precautionary savings because they want to be prepared for the recession, they'll solve the inflation problem without causing a recession. So, maybe the Fed is really on its game, and that was very purposeful. So I think it's, the situation we're in right now is a world in which a lot of our inflation problems have been caused by the fact that what we want to buy has changed. Where we want to buy our houses has changed because of remote work. What kind of things we want to put in our houses has changed. We don't go to gyms as much anymore. We have a lot more home gym equipment. We don't go to movies as much anymore. We have a lot more home movie theater equipment. So it's this supply demand mismatch. It needs to, we need to solve the problem. So we need to solve the problem of housing supply. We need to solve the problem of the supply chain snarls. When we think about our tools for reducing inflation, though, most of them are really about reducing demand. And reducing demand stops inflation the way Tylenol stops a fever. The fever is going to be gone, but it doesn't address the underlying disease. And so if there are particular markets that are struggling, like housing, from inadequate supply, the monetary policy and other fiscal policy solutions are not going to treat that disease. They're going to make the fever go away, but they're not going to treat the disease. And so I think, it's absolutely important that we keep inflation expectations anchored, that we get inflation down. But there are some diseases underneath this inflation that we have to treat. And that treatment requires more than just the Tylenol of monetary policy.
Meaning that and some other actors need to be part of the conversation as well, I think. So Bill, I want to get you in here, and I also want to ask you a question. Are we in fact, I think we're having some static, but are we in fact at full employment? I know you've been doing a lot of research on how subpopulations are experiencing the recovery in the jobs market, and I think it is a different experience for different parts of the market. So let's try to go into the differential impacts. But first, you may want to jump in here too.
Yes, and Betsy, I think where she was going, or what I heard in what she was saying, and there are these underlying diseases. What I interpret that as basically there are these structural forces, or there's a set of scaffolding that for certain individuals or certain communities creates challenges for them. And even when you have an economy that is as strong or recovering as it is, they still, those individuals and communities still are struggling. For example, I've just published a blog on our bank blog setting called On the Economy, and one of the most disturbing or challenging things we find in this post is that one of the positive pieces is the dramatic recovery in employment population ratios since April 2020, but we don't see amongst these young, non-college educated men and women, they're between 16 and 24 years of age, who have no more than a high school degree, we don't see a narrowing in racial inequality. That sort of 10 to 15 percentage point difference in employment prior to the pandemic stays all throughout the recovery. For me, what that's telling us, another piece of evidence that supports or tells us there's, like in the labor market and also housing markets and other markets, that there are these scaffoldings that are, or structures that still persist. And yes, we've really gotten down to what many economists will call of the structurally unemployed, where those individuals face a variety of barriers. So the pandemic shined a great deal of light on some of these barriers, particularly health differences between blacks and whites, which lead to your ability to be productive in the workforce, which leads to economic growth. We saw how childcare, the absence of childcare, really impacted moms' abilities and dads' abilities to be and contribute into the workplace. And my staff we've been interviewing a variety of service providers in our community impact survey. And one of the very disturbing things there that people were talking about is that they were thinking we're not going to get back to normal new normal for another 12 months. And that was before inflation really took off and became a major household issue. So what I see is really we're just moving from a pandemic shock to now this inflationary shock. And if we don't address the underlying diseases that these young minority men and other women, and even young, less educated white men that they're facing, or we don't address these underlying structural problems, and we particularly by pulling back the relief and recovery efforts that we did because of the pandemic, we're only going to set up this new young generation who's trying to enter the labor market, that they're just going to be having challenges today, but not only challenges into the future. There's been an ample amount of research that has shown right? When young, less educated, or even young cohorts come in during economic shocks, economic downturns, that it not only can have an adverse effect on their opportunities today, but it also has an adverse effect on their future growth, which again, let's connect the dots. That's improved productivity or lower productivity, which then means less economic growth at the macro level.
So if you think about a larger conversation around the structural barriers in the economy for opportunity for communities of color, for rural communities, for others, in some ways, these periods of shock, I think I'm hearing you say, are reinforce and kind of erect further barriers to closing those gaps. And so first you got to get out of the moment as fast as you can, but then you need to go back to work on the underlying diseases, as Betsy said. So I would have lots more I would love to be asking about here, and we'll come back to the, oh, go ahead. Bill.
The one thing that I found really fascinating coming out of the Great Depression was the use of the 3 R's: relief, recovery, and reimagination. And what we've done is, I think, a pretty good job of the relief and recovery. We probably are going to need to do some more relief recovery work, such as having the unemployment insurance system ready to go if we do see increased job loss. But we also have to reimagine. Do this reimagining to address these various diseases or these various structural challenges or problems that communities are facing.
All right, so I think we'll come back to this at the end, but I wanted to spend a little bit more time on the housing market. Mark, when we start with you, you started to talk a little bit about this in the balance sheet context, but you have written with one of our Urban Institute fellows, Jim Parrott, a piece about that arguing essentially that unless policymakers deal with the housing supply demand mismatch, the housing price increases will continue to contribute as a driver to inflation. So I'd love to hear your thoughts about what role you see housing playing. I've also seen, though, you write that there are at least some markets now where some of the prices are likely to stop because they've sort of gotten beyond where the underlying dynamics would suggest they should go. So would you talk about what you're seeing going on in the housing market and its relationship to the inflation issues, and particularly the distributional impact of those forces?
Yeah, sure. Well, first, let me say back to full employment. I don't think we're at full employment. I don't think an economy that creates 500,000 jobs every month is at full employment. I just don't see how that's possible. I mean, in a typical economy, you'd be creating, given our current demographics, 75,000 a month, maybe 100K, something like that. So folks are taking jobs. So that means there's still folks that are there to take jobs. So I don't think we're, quite there yet. Got a little bit ways to go. On housing, I view this as a very significant part of the inflation problem. There's many aspects to this, the housing supply shortage and the implications of that. But, if you look at the consumer price index, the CPI, 1/3 of that is housing costs. So, we can get energy prices down, we can get food prices down, but if rents are continuing to grow very rapidly because there's just nowhere, the vacancy rates are low and there's just no affordable housing, inflation is going to be a problem, particularly for low-income households. Everybody's got to live somewhere, and low-income households are devoting 30, 35, 40% of their income to rent. The other thing to consider is if everyone has to spend more on rent, it's much more likely that they're ever going to be able to own a home, right? Because if I'm shelling it out for rent, I can't save. If I can't save, I can't get a down payment. If I can't get a down payment, I can't buy a home. If I can't buy a home, I can't participate in the wealth creation that is afforded by home ownership. And you can see that. And I think that's one of the downsides to, the high rate environment that we're not going to live in. It's going to undermine demand for first-time home buyers, reduce home ownership, and it's just going to make it more difficult. So the solution to the problem, fundamentally is we need more supply. We need more homes. Now, I think the housing market, home builders are fortunately putting up more homes. They can, it took a long time to get the infrastructure to build back up after the financial crisis and the collapse in housing. But I think we're there now, and builders are putting up more homes. And in fact, interestingly enough, there's a record number of homes in the pipeline going towards completion. So that's a very good sign. And the only reason why they're not getting across the finish line is because of the supply chain issues. Builders can't get appliances, they can't get building materials, and so they can't complete the multifamily or the single family homes, but they will, and that'll get it across the line. But even after that, we're left with this massive shortfall. And by my calculation, in the work Jim and I did, it's about 1.5 to 1.6 million homes in shortfall. That's the homes we need just to get vacancy rates to a place where rent growth is more consistent with underlying incomes and underlying house prices. And we could let the marketplace work, and that could take a long time and certainly not work the way we want it to for low income households that are in communities where it's much more difficult to build affordable housing. Or, this is a good place for policymakers, fiscal policymakers. This is where they can step in and provide some support. You saw the White House came out with a white paper on supply side proposals earlier in the week. And, I thought that was a pretty good list of things that could be done with regard to zoning and permitting. Neil mentioned that with regard to financing, manufactured housing. It could be a very good source of housing for low income households. But the problem is these are chattel loans and there's no secondary market, and therefore interest rates and the cost of these loans are very high. There's a lot of proposals around supply chain issues, labor market issues. So and tax incentives. I think there might be some bipartisan support between Democrats and Republicans on, for example, juicing up LIHTC, the low income housing tax credit, or the neighborhood home tax credit, or new market tax credits. These are things that would help support affordable rental in underserved communities across the country. So, we could take our chances, let's see how the market works here. And we're probably going to be living with high rent growth and the resulting high inflation for a long time to come, the casualty of which will be low income households, or, lawmakers could get it together and, work to try to improve the supply of housing and fill that void, fill that shortfall more quickly, and get more homes out there and get rent growth down, get inflation down, and really to the benefit of the folks that we want to help here.
Thanks very much. Betsy, I know you've been thinking a little bit also about the housing supply demand, and Neil mentioned this idea that maybe some of our assumptions about the economy have changed a lot in the last year or two as we organize ourselves and lives differently in the pandemic. I'm curious your thoughts about this role that housing may be playing in inflation.
I wanted to actually start exactly where Mark had started, which is, are we at full employment? And I think what has been kind of amazing is we're approaching it, but we're not quite there. And we're still trying to figure out what return to normal looks like. And one aspect of the way in which we are returning to normal is in terms of our immigrant labor force. So if you looked at sort of the end, sort of three quarters of the way through 2021, estimates showed we were missing about 2 million foreign-born workers of working age. I just redid that for April of 2022, and we're only missing about 1 million. So we've closed that gap by half. And the thing that really surprised me, but maybe wouldn't surprise other people, is almost all of the gap that remains is women. And it's the jobs that are closing the gaps, which are caregiving jobs, which those immigrant women are often likely to take. So that gives you a little bit of a sense of what's going on in the labor market. How does this all pivot to thinking about the housing market? Well, part of the return to normal is actually figuring out where we're going to live and work. There is a really beautiful and well done NBER working paper that just came out by John Mondragon and Johannes Weiland. They're at the Federal Reserve Bank of San Francisco and UCSD. And what they found was, of the nearly 25% rise in housing prices, so that tells you why we're talking about the increase in housing prices. They've gone up a lot since 2019. Over roughly half of it is due to the switch to remote work, which caused people to relocate themselves around the country. I think that one thing that remains a question is, will people end up moving again? And how will that end up shaping housing demand, and how will that end up shaping housing prices? I think it's too early to say, but those are real sort of fundamentals around where people want to live and where they want to work that is driving up the price of houses. When I said that our policies for fighting inflation are really about their Tylenol bringing down our fever, not sort of treating any kind of underlying disease. This really applies in the housing market, because what happens is the Fed's going to raise rates to sort of everyday people out there. It's not making houses any cheaper. It might look cheaper to us when we measure CPI, because now they're paying a lot more in interest on that mortgage than they are paying for the house itself, but it brings down demand and brings down the sticker price by bringing up the financing price. So what people need in order to bring down housing costs is exactly what Mark was saying. We need more housing. We need, and it's actually what Neil Kashkari was saying, which is we need people to not shut people out of their neighborhoods. You need to get rid of any kind of zoning restrictions that say, no to multifamily homes. And I want to link this to the caregiving that I just talked about. What are the jobs that haven't recovered? We haven't seen any increase since the pandemic began in people working in residential care facilities, nurses in residential care facilities. People don't want to put their elderly parents in residential care facilities anymore because they don't feel safe. And yet, most of the countries does not allow the very easy solution of accessory dwelling units to be built affordably and with permits in their communities. So there are lots of ways in which we could address the disease of inadequate housing supply that will make it easier for people to work, to move to where they want to be, where they want to live, to move to childcare, to be near their parents or their in-laws, and to be able to move in an affordable way. Because what happened was all that sort of reallocation was a big driver of the housing price increases we've seen. It wasn't all Fed policy.
So I am dying to host an entirely separate conversation about understanding the distribution of demand for housing and its changes, because I can understand that the remote work has also caused us to consume more housing and in some ways shift the cost of occupancy of work onto the person who is the employee rather than the employer. Yet another way we shift risk onto employees. But I'm not as quite sure whether those same people who are moving, they're also vacating homes. So I'm very interested in sort of understanding those dynamics around how it's affecting individual markets. One thing you learn if you're a houser is everything is local. It's not just a national number. So a hugely interesting conversation, Betsy. Thank you. So I wanted to turn to some of the themes that are going on in the chat. And just to preview, I hope we can get in our 12 minutes left some conversations about income inequality. I hope we should talk about whether or not 2% is actually the right target. So we're going to do kind of speed rounds here. We have some really interesting questions about climate and its impact on housing market and inflation as well, but also more generally on costs for low-income consumers and volatility. But I think I wanted to start with one. I don't know, Bill, if you're going to feel like you can jump in here or not, but that really go to the role that large companies play in inflation. There's certainly a political narrative, if nothing else, but I think some credible analysis that are asking questions about the earnings pass-throughs versus cost pass-throughs. Sort of in political terms, that's a conversation about so-called corporate greed and profiteering. In the views of panelists, what is any part of this discussion about the role of the employer, particularly the large employer, in inflation helpful to our understanding here? Anyone want to take that one? Bill, you turned off mute. Good for you.
Yeah, I'll share a little bit about it on some thoughts. I mean, has been shown. I mean, there's no single contributing factor, right, to to the inflation experience we're having. The unfortunate part here is that aspects of this inflation conversation have become political, as you just pointed out, and so it's hyper. The conversation's gotten to this hypersensitive level, and there is, I think, some truth to some of the concerns around employers acting the ways you described. But I think the bigger challenge that the bulk of employers have been facing, is how to, in this economy where we have an unemployment rate at 3.6% and participation rates or population ratios are almost back to where they were. And that is really how to find, attract, and retain the talent that they need. And that's been the big issue. And if you think about, again, I don't think it's the leading factor that got us here, but during this recovery, and even before the pandemic started, and as labor markets got tight, I think I would attribute a lot of the growth. It's been growth that we've been seeing has been firms or employers, and these first at the lower end responding to calls to saying, hey, you need to be paying a living wage. And there are economic arguments that can be made for that you're raising their productivity by they're not searching as much, or you're lowering your training costs, you're lowering your search costs. So those are the explanations that I have been looking at. My staff has been looking at. Just one quick comment on the housing discussion there is that my colleague and staffer Faith Leafley, one of the things that she's really pointing out and doing some writing in her blogs, has been just this concern that, and we're starting to monitor the eviction data, are we with again the pullback on support, so that relief and recovery, and now we're moving to this new shock, are we seeing evictions, and then the final thing too on the housing piece is that she talks about, and I'm forgetting the name, but there are a variety of products, we don't endorse a particular product or a particular policy, but there are some types of mortgages for low-income people, that families that could be potentially useful for helping get us to the finish line where we solve the supply problems that Mark and Betsy were talking about.
Yeah, we're doing some work with the Federal Home Loan Bank of San Francisco on innovative mortgage products to expand access. So others in the spirit of speed round want to weigh in on this question of the role of corporate response to inflation?
I would say that my general view is that corporations have been greedy for a long time, and inflation didn't make them any more greedy. So I don't think they're responsible for, corporate greed is not what's fueling inflation. And in fact, sort of monopoly power, should and gives them actually more space to raise wages without having to push the costs on to consumers. I think though, like the cynic says, well, there's a lot of people pointing to this because, it polls really well, or the public likes to hear this story. I think actually there's a real story, which is that I'm sick of it. I'm really, really sick of people not making space for a living wage. If you're a corporation, you're making sure your shareholders are getting paid really well. They've done great through the pandemic, and you aren't looking out after your workers. And it's just, I think people's frustration with the imbalance has grown. So I think we want to separate. People want to see a change. They've got maybe less patience for union fighting, like the way Starbucks is fighting the union at Starbucks, and saying, well, that's what's causing inflation right now. I don't think it's what's causing inflation, but now's as good a time as any to rein in corporate greed, because it's always a good time to rein in corporate greed.
Mark, you want to jump in there?
Yeah, I'm sympathetic to what Betsy said. I mean, I don't think market concentration has contributed meaningfully to the significant acceleration in inflation. But having said that, I think it's perfectly appropriate and reasonable for the executive branch of government and Congress to shine a bright light on potential bad practices that might be leading to price gouging or other inappropriate types of pricing behavior, just to make sure that everyone stays honest. It's part of the oversight regulatory process. So I don't think it's amounting to anything of consequence, but that may be in part because lawmakers are focused to make sure that it doesn't become a matter of consequence.
Sarah,
So,
I'll just say one more thing to that, which is, I think that people get confused about the difference between pro-market policies and pro-business policies. I am pro-market. I think a competitive market is the best thing for workers and for our economy. But what a lot of what happens a lot is we see businesses who try to structure a policy environment that protects their interests and actually reduces competition. And so, what makes me sad is to see the idea of market competition thrown out the window because people are frustrated by corporate behavior. What we want to do is make them more competitive because competition is good for everyone.
So I will say, Betsy, there's interest in the chat on further reading and ideas about the role that unions played, positive or negative, in wages increases and inflation in the 70s. So maybe if you'll send us some links, we'll put them on the event page later for our audience. All right, I am really going to enforce a 45-second rule for each one of you. Is there something we should be thinking about in the short term, medium term, or long term around climate change and impact on prices and inflation? Mark, you want to go first?
Yeah, well, I think in the very near term, the issue is around physical risk, acute physical risk, chronic, and when I say acute physical risk, hurricanes, floods, and chronic physical risk, and what it means for insurance costs, which then become a matter of the cost of housing and commercial real estate values. That's going to be the most significant link back from climate change to the economy, at least in the very immediate future. And it's consequential. I have a home down in Florida, and I can see what's going on down the coast. Insurance costs are rising very rapidly, affecting development. So that is the key link, I think, here in the very near term.
Bill?
Yeah, I'll just share that this is an issue that Nishesh Chalize, one of my staffers, is going to be working on. We think it's a very, very important issue, particularly, again, the equity issues that the individual pointed out, that folks who are in the lower part of the income scale and even up to the moderate part, they're the ones who are being more adversely impacted by climate change. And it just reminds me in a different way, reminds me of what Secretary Herman, who I worked for as their chief economist in 2000, when we had a great economy with low unemployment like this, very low sustained unemployment. But she would always remind viewers or people she was talking to, maybe 3.6% nationally, but it's not everywhere throughout the United States. There's tremendous variability, and they're in a variety of costs that people face.
Thank you. Betsy?
So, the inflation people hate the most is gas price inflation. They absolutely hate it when gas prices go up. And you can see, recently some Pew data came out that had something like 75% of people thought inflation was a very big problem. The amazing thing is you can go back to 2013 when inflation was below 2%, and 50% of people thought inflation was a very big problem. Why? Because it was a period of rising gas prices, and people absolutely hate it. They stand there at the pump and they see their money just flowing out of the pocket as the gas flows into their car. And so the most important thing we could do to end gas price inflation forever is get us off gas-based vehicles. If we move to electric vehicles, it will end all the pain and suffering that comes from gas-based vehicles. So we need to move to sustainable energy because we are impacted by global energy prices. There's nothing anybody can do in the United States right now to bring down energy prices for us. This is a Russia problem. This is a global problem. The only thing we can do is move forward to more renewable sources of energy. And ultimately, that's good for climate, that's also going to be good for this pain and suffering we have whenever we see gas prices go up.
Hey, Sarah, one
Yep.
word, carbon tax solves the problem.
All economists love carbon
Come
taxes.
on, just come on, come on.
If only it's not so good on the politics, but it's awful good on the policy.
Yeah.
And I'll just add to Bill's point, my colleagues here at Urban have done work that demonstrates that when there's a severe environmental impact, like a hurricane or a flood or the like, the long-term credit scores of middle and upper middle class families rebound very comfortably. And you see lasting impact for low and moderate income families that never fully recover the financial health that they had before these climate. So these issues are, like, as always, closely interrelated. And that's why we're so lucky to have had this integrative panel of folks who can bring it all together. I thank you guys so much for being with us and hope we will find ways to continue the conversation with each of you. Thanks to our audience for being here, and tune in again. Take care.